So a lot of different things are taking place overall in the globe right now. Domestically here in the States, we're starting to see home sales decline to 2010 levels as interest rates are remaining kind of elevated here. And this is something we've talked about, that 10-year treasuries are going to be a little bit stickier, a little bit higher than everybody anticipated. Even though the feds are cutting rates, they really can't control the longer end of that yield curve. We're also getting confirmation that North Korea is sending troops to Russia. Now, this could end up being a huge problem, and things are just extremely crazy, but yet we're looking at a market that's trading at extreme heightened levels. And so in today's video, we're going to simplify everything here. We're going to go back to some basics. We're going to talk about Peter Lynch's 6 stocks that you can own. This will simplify exactly what you're looking at when you're looking at the stock market or an individual equity. Now, on this channel, I always recommend just buy a broadly diversified index, set it, forget it, ignore all the noise that's going on globally. But for those individual stock pickers and people like myself who manage some family money, we have to kind of stay on top of these types of things. And if things couldn't get any crazier and you want to run away and hide from this pain, maybe eat your feelings, well, you can't even do that because McDonald's now is having issues with E. coli. Seems that their quarter pounder has been carrying E. coli, multiple cases of people being ill, and I believe one confirmed death at this point in time. So it's definitely crazy, but let's dive into some opportunities that could be presenting themselves. That's what we kind of focus in on this channel, and it's definitely more of a contrarian channel. My best videos are ones that get absolutely no views. For example, I talked about Barrick Gold being tremendously undervalued with gold prices skyrocketing. That stock is up over 50% in the last 6 months. I've done companies like Sprouts Farmer Market back in the day. That's up over 300%, and that one didn't get a lot of views either. But in today's video, I want to stay focused on Peter Lynch's 6 types of stocks here. Now, stock number 1 is going to be a slow grower. It's exactly what it sounds like. When I think about a slow grower, I'm thinking about companies like Verizon, AT&T. They pay kind of dividends. They don't really have a tremendous amount of growth, but they're steadily and reliable. They basically keep up with GDP, but nothing special. You're most likely not going to get an outsized rate of return with these slow growers, but they're kind of just steady, slow, predictable earnings. Some characteristics you do want to look at when it comes to slow growers is going to be you do want to see some sort of earnings growth, an attractive dividend yield, good balance sheet, and good management in place. That's kind of what you want to look for when you're looking for those slow growers that have been there, done that. You know, Coca-Cola comes to mind as well for a company like that. Next is your stalwarts. These are going to be your most reliable, most predictable equities out on the market. We're talking about your Microsofts, your Apples. This is a company that normally could maintain earnings in a bad economic backdrop, grows a little bit more than your slow growers, and usually sells for an attractive PE ratio, so you have some upside opportunity in it. Next up is going to be your fast growers. These are going to be kind of your smaller companies, not as large, not as well known as maybe a Microsoft, an Apple, a Coca-Cola, a Verizon, AT&T. Fast growers are considered more of a higher risk, higher reward. Some names that come to mind for me is something like maybe a Pinterest, Palantir, a SoFi. These are companies that are growing rapidly, over 20% growth rates, that have an opportunity to really outperform the market. But once again, higher risk, higher reward type of stock. Good qualities you want to see is not a lot of leverage to these companies because they are smaller cap companies. You don't want to see a tremendous amount of debt on that balance sheet. Once again, great management in place, and that there's multiple years of this continuing growth going forward. Ideally, you want to see these companies trading around a 1 PEG ratio, which is price to earnings divided by the growth rate. Next is your cyclicals. This is going to be very sensitive to the economy, ups and downs. They have huge moves to the upside, huge moves to the downside, depending on economic activity. We could think of things like airline companies, a lot of your industrials. These are essentially companies you want to start accumulating when times are really bad. So when things do get better, you're going to see that stock appreciation, earnings growth, cash flow growth come back once again. So the cyclicals are a little bit more sensitive, and you have to kind of time them and understand the business model very well. Now, the one I want to highlight are turnarounds. So we're not going to talk about them right now, but the next stock up is going to be the asset plays. These are companies that are fairly depressed prices, but might have something that's being overlooked by the market. Now, I think a good example of this would be a company that might be getting overlooked by the market, but has a tremendous amount of Bitcoin on its balance sheet. And with the big move in Bitcoin, well, those assets are going up. So there's a tremendous amount of liquidity that might not be getting looked at by the market. Or maybe they have a unique technology that they're developing. that could come through the pipelines and really explode revenue growth. But it's something that's kind of being overlooked by the market, and it's not necessarily the business itself that you're buying, but it's essentially the assets that are getting overlooked that you're buying. Another way I would look at this is kind of like looking at Paramount Pictures. If Paramount Pictures separated all of its assets, I actually think they would be worth a lot more separated than they are as a whole run as a business model. So why I want to specifically talk about the turnaround plays is I think that the stock market has the most turnaround plays that I've personally ever seen in my experience of investing. And let me explain what I'm talking about. We're looking at Starbucks with new management in place, trying to do a turnaround right now. We're looking at a company like Nike trying to do a turnaround right now. We're looking at companies like CVS, Intel, and many, many others that are looking to turn around the business model and get things back on track. And so I wanted to focus on turnaround because I think that's where some of the biggest opportunities are in this stock market. Now, to kind of go back, turnaround stories are a high risk, high reward. You can almost equate them to a growth type of company when you look at the risk versus reward type of curve that it appeals. So I wouldn't have too much exposure to both turnaround stories and growth stories. But with turnaround stories, the one thing you want to focus in on is going to be the balance sheet, not carrying too much debt, because they're putting all their time, energy, and resources in writing a big ship. The last thing they need to be worrying about is handling a massive debt load. They need to be spending in the right places to get things right. And so balance sheets are extremely important when we talk about turnaround stories. Now, you do want to be kind of patient with these turnaround stories. You want to make sure that management is executing and that they're starting to head on the right direction. And so not to keep talking about one subject, but it is a subject that I follow. It's Pfizer. Their management basically kitchen sinked a bunch of earnings, and now it looks like earnings are back on the rise. So I do think the worst is possibly over, but once again, it's a higher risk, higher reward story here. It seems like some things are actually coming through on their pipeline, and over the next 3 to 4 years should be something that attributes to their top line revenue growth. And the fundamentals are starting to regain behind them. Now the question is, can management execute? And if they don't execute, you need to exit these pretty quick. One company I was actually looking at recently here is Goodyear Tire. This to me, once again, is another turnaround story. When we look at a lot of the stocks that are in the stock market right now, there is a tremendous amount of turnaround stories. VF Corp is another one that comes to mind. When we take a longer look at this chart, we can see that this is much like a cyclical business with the ups and downs, the ebbs and flows of a strong consumer versus a weak consumer. So economically sensitive, as we can see by this chart. Another company I'm actually looking at here where the growth is slowed down. This was a somewhat of a fast grower here, a smaller cap company. Market cap is sitting around $3.7 billion, and that's going to be Academy Sports. You can kind of look at this as a sporting goods store, much like Dick's Sporting Goods, trading at a forward PE at 8 times earnings, pays a little dividend here. This company IPO'd in 2020, and you can see the long-term chart is very nice in this, a nice upward trajectory here. And when we look at the one-year chart, it's the complete opposite. We've seen it hit as high as $75 a share and as low as $43 a share. So this one is definitely piquing my interest because it looks like they're starting to get aggressive on expansion here. But when we look at EPS growth, this was a company doing $1.66 a share to nearly $4 a share, jumped up to $7 a share, and it's kind of floating between, call it $5 to $7 a share, which means that the valuation is pretty reasonable, and it looks like there's some initiatives here for the company to reaccelerate on the growth side. When we look at forecasts, they have a low of 51, a high of 83, and with the growth initiatives, it looks like 2026 and beyond, we're going to start seeing possible reacceleration of growth and reacceleration of EPS, which then stock price would follow. Possible EPS growth and high return on invested capital, and they're doing all these things, and they're in a small cap company, which means that there's opportunity for them to kind of exceed growth rates of your larger type companies that are out there. We also have an initiative that management should be expanding here pretty aggressively. So there's some underlying value here that looks like could be happening for a company like Academy Sports. The problem I hate with this is these storefronts get me very nervous when you have companies like Amazon absolutely dominating when it comes to just delivering same day almost any item you can possibly choose from and being competitive on the pricing. So these companies do make me a little bit nervous. Even at Dick's Sporting Goods makes me a little bit nervous. Now the opportunity is you can go in and try the product before buying it. They definitely make me a little bit nervous when we look at what Amazon's doing and when we look at the at-home type of shopping that's available. So the next time you go to look at a stock, try to pinpoint it in one of these 6 categories. And once you figure out one of the 6 categories that the stock you're looking at fits in, go back to Peter Lynch's thesis, take a look at what he was looking at and see if that aligns with the type of stock that you're looking at. This will give you a better opportunity for success when you're investing, especially looking at somebody like him who has an unbelievable track record. As always, ladies and gentlemen, really appreciate your time, and we will see you in the next one.